Hello everybody, so welcome to another video tutorial. Today's tutorial is basically we're going to be trading inside bar patterns, but we're going to be trading them as a major reversal signal. Now, for it to be a major reversal, we obviously want the inside bar pattern to occur at the end of a strong move in the market. So the way we're going to quantify that we've had a strong move is we're only going to take inside bar patterns which occur after a period which is closed outside of our Keltner channel. And what we're hoping for that to achieve is that it's going to help us avoid trading choppy markets, because you do get a lot of inside bars. If I just give you an example, we've got an inside bar here, we've got an inside bar here, inside bar here. So we're trying to avoid trading through chop. And what we're actually looking for is inside bars which have happened. You know, if there were an inside bar here, then that would be a reversal signal. So I'm just going to go through the chart. A couple of rules. Basically, when we do get an inside bar pattern form after a candle which is closed outside of the Keltner channels, we'll take the trade so long as the high or low of the inside bar has been broken within the next 3 periods. Now, obviously, if we're trading a bullish inside bar, such as here, so this would have been a qualified inside bar because this candle closed outside of the Keltner channel. The next bar is an inside bar, but within the next 3 periods, we would only take the trade if the high was broken. Now, if we're trading a bearish inside bar, so we're looking for a reversal of an uptrend, then just reverse the rules. So we'd need a candle to close outside of the upper Keltner channel. We'd want an inside bar, and then we'd need to break the low of the inside bar within 3 periods. So I'll just go ahead and pause the video, and over the coming months, we'll see which trades set up, and we'll take them. Oh, and by the way, the entry and exit rules of these of this trading strategy will always be the stop loss will be beneath or above the inside bar, depending on if we're shorting the market or going long the market. And whatever our stop loss is, we'll always double that for our profit target. So our risk reward will always be 2 to 1 on the trade. So I'll just pause the video here, and I'll periodically come back to it whenever we get a signal set up. This chart is going to be Apple, so we're going to test Apple for the whole of 2013, see if we get any signals. Okay, so as you can see, on July the 25th, we have a valid inside bar reversal signal. So if you see, we've closed outside of the upper Keltner channel. It's a bullish candle, but then we've had a bearish inside bar. So if we can break the low, so a penny beneath the low is going to be 435.81. So if we can get 435.80, in the next 3 periods, we're going to go short with a stop loss above the a penny above the inside bar high, which is going to be at 441.41. Okay, so we took out that low, so we're now short the trade with our stop loss up here. So on the first day, it's reversed quite quickly, so this is likely to be a losing trade. And as you can see, the trade, we were stopped out here at 441.41, so just in here. So the first trade of our system is a loser. So we've lost 1 risk. If you always think of your strategies in terms of risk multiples, each trade we're going to risk 1 R, which is risk, and each winning trade we're going to make 2 R. So we can just jot that down that we have lost 1 R. Okay, so we've gone a good couple of months now without a trade setting up, but finally now on the 17th of September, we have an inside bar pattern. So the inside bar, because the low of the preceding period was 447.22, and the low of the inside bar was obviously higher, so it's 447.50. So as you can see, the inside bar pattern is here. The preceding candle met our rule, which is it closed outside of the lower Keltner channel. So we're just going to take that trade on a breach of the high, and it's our stop loss is going to be down here, a penny beneath the low. So our stop loss is at 447.49. Our entry is at 459.72, and we're going to have a profit target which is twice the size of our stop loss. Okay, so as you can see, the next day the market gapped higher. So what we would do on a day like that is we would buy as close to the opening price as possible. Now the open in this case was 463.47. Actually, the gap up gives us more confidence that the trade is going to be a winner. So the problem with it, of course, is our stop loss is now wider. So what you would need to do is obviously reduce the amount of shares you bought to keep your risk on the trade constant. And obviously our profit target is now going to be further away as well, because it's going to be twice the size of our risk. So if you're buying it at the open, which is 463.47, and our stop loss must be down here. So you've basically got a 16-point stop loss. So we need a 32-point profit target. So that's going to be up here at 495. So I'll just go ahead and pause the video and we'll see if we can get there. And as you can see, a few days later, we've gapped up a good few times and we got taken out of the trade there for a 2 times risk winner. And that means that net on this particular chart for the year of 2013, trading this pattern would have been a 1R gain. Now, obviously, you know, 2 trades a year seems like not many at all, but the point being that there's 8,000 stocks from which you can run this strategy. And if you check out the video page on the website www.backtestwizard.com. I'm also going to put up some tutorials which show you how you can screen your charting software to only give you stocks which meet certain candlestick rules. So we can only get stocks which have got inside bar patterns, outside bar patterns, kicker signals, some doji signals as well. So check out those videos, and what that enables you to do then is at the end of each day, all you have to do is click on run screener, and you're just going to get a list of stocks which meet your specific candlestick trading rules. And it's a great, quick, cheap, easy way. Well, it's free, in fact. It's not cheap, it's absolutely free. So that's a great way of just running it every day, and you're always going to get 2 or 3 stocks which fit your trading rules, and then you can check your fundamental screener as well to make sure that the stocks pass your criteria for whether it be sales growth or profit margins or debt ratios, however you like to you know, make sure that your stocks are not basically dogs. And yeah, you can incorporate the whole strategy then into something you can run in 5 or 10 minutes every evening, and all you have to do is monitor the market on the open in case there's any gaps, such as we saw with the most recent Apple trade. And that's just a great way of having a trading strategy which has very specific rules. It's going to minimize any type of emotional baggage which you may currently be going through with your trading, because there really is no room for ambiguity. All the rules are very specific. So thanks very much for watching this video, and look after yourselves. Take care.